Well, thank you, everybody. So everybody came here for this presentation on accounting. Woohoo! Yeah, really exciting. So any innovation accounting will always start with the idea, the big, fantastic idea that you have that's going to change the world and make you rich and famous and produce huge amounts of wealth for the firm. And so all you need to do is just go together and gather the resources to make that happen. So you put it together and you go to your finance team and they say, great idea. So what's the ROI? Yeah, and so you get a little bit nervous, but you're like, no, it's okay. I know how to do an ROI. All I have to do is predict all these big revenues in the future. And yeah, we spend a little bit of money now, but eventually we're going to have this huge hockey stick and everybody's going to be happy, right? And so you say, if you have a long-established history where you can draw trends, that's not an unreasonable proposition. But when you innovate, there's no history from which to draw. And so this curve is certainly possible, or this curve, or this curve. And of course, there's no possible way to know until it's too late. But only one of these curves actually gets funded, because no ROI means no money. So you know how to do this. You just go ahead and make your revenue projections. Oh, that's right. Finance knows that you're a risky project, so they're going to discount them heavily. So you have a very simple solution. Bump up your revenue projections even more, right? And so the process of determining ROI becomes this exercise in tweaking your Excel spreadsheet to the highest possible revenue you can and still maintain plausibility and not go into the area of ridiculousness. Has anyone done this before? Does anyone have a friend who's done this before in some other company that, yeah. Look, we understand what's happening here, and we know what we have to do. But what we have to realize, at some point, you're going to get to your quarterly review, and those revenue projections are not forgotten. They, in fact, are going to be brought out at the exact moment that you predicted the hockey stick would appear. And you know this. In other words, it's a trap. It's a trap. Of course it's a trap. But look, before we get too hard on finance, let's consider this from their perspective. It's finance's job to allocate the scarce resources of the firm. So they see two presentations. One of them is, we're going to spend this amount of money, make $100 million in 5 years. Here's my Excel spreadsheet that proves it with these Gartner reports that are the best money can buy. They'll produce an Excel model that is so beautiful and sophisticated it'll make you weep with joy. And then there's the other proposal, which is, yeah, please write me a big check. I have no idea what it's going to return, but I am going to fail a lot as I find out. One of these proposals is fundable, and one of them looks like this. And look, before we get upset and blame finance, or blame product, or blame those Gartner analysts, we have to realize the accounting is the problem. Now, Eric has convincingly demonstrated that you really shouldn't show an ROI for these early projects. But if you absolutely positively have to, if they won't let you do anything or even get started without showing the ROI, then we're going to provide some options to you. And by we need options, I mean we actually need financial options. Now look, financial options can be very arcane, and look, they can be super complex. But has anyone here ever bought a house and had a mortgage rate lock, right? So that's an option. What you're basically saying is, I want to have the right to do something in the future, but not the obligation that's priced in the present. And the reason they're used is to delay investment decisions until we know more about the market. And so they're present in real estate, in finance, in agriculture. Basically, wherever there is uncertainty, you will find options that manage it. And there is nothing more uncertain than your innovation project. We need innovation options. So, what is an innovation option? Well, an innovation option takes place before your main product. It gives you the opportunity to learn and test your assumptions while still showing a positive value for those actions. So let me explain in a little bit more detail. Let's say you have your big project, the big vision you want to entertain, and it's like a Series A investment or your big proposal, $10 million. And you say, okay, this is going to return $100 million. Now, if you were doing a traditional accounting, you'd have to stop right there, because anything less than this and you're not going to get funded. But let's just go ahead and be honest. It could be 100 million, or it could be 0, or it could be anything in between. And what's more than that is that as you go through time, you're going to have different valuations as you get closer and learn more about the market. So an innovation option simply takes all of those possibilities, discounts them and their expected value, and produces the sum of them together. That's the value of your option. Now, this math actually comes from standard financial option pricing theory. And so we could use those equations to be able to generate that number. And here they are. Okay, sorry, hold on. Nobody run for the door. This is why God created software. But look, the financial equations, they are somewhat complicated. A version of this won the Nobel Prize, after all. But at its basic point, it's simply saying there's a range of potential outcomes. We need to figure out which is which. Okay? So we start with this potential range of things, and we say, okay, $10 million is what we're going to spend to invest in the project. That's what I'm suggesting we'll do in the future. Now we want to predict a range. That's the first input, what you're going to spend. The second input is the range of possible outcomes. So we'll say it's $100 million. You don't have to guess the worst case scenario. We know what it is. It's 0. And then the last thing we simply need to do is say, how many iterations are we going to do over what period of time? So we'll say in this instance, we'll do quarterly innovations over the course of a year. From these 3 simple inputs, how much you're planning on spending, the range of return, and the frequency of iteration, you can use these financial equations to actually calculate the value of this option. $10 million, 0 to 100, 4 iterations of a year. Today, the value of that option is $3.3 million. Now, that doesn't come for free, the 4 iterations over the course of a year. So you actually have to propose the budget that says, okay, if we need to find out what this answer is, we're going to need some money to do so. So we'll say, over the course of the year, we're going to spend $1 million. Consider this your seed investment. This is your lean startup premium. And so if the value is 3.3, and you're going to spend $1 million to find out the answer as your premium, your return on investment today is $2.3 million. Lean startup, positive ROI. Yes. Now, we can also do a little bit more. You get your check, you've got your $1 million. Now it's up to you to learn. So let's start learning. When you see the pricing tree, what you'll start to notice is that every node is connected to another by a simple of very simple moves. It goes up, it goes down, or it remains the same. Therefore, in order to determine the value of your innovation option, you only need to answer one question. Given what we have learned since the last iteration, are we better off, worse off, or about the same as we were before? Now notice we don't have to do any recalculation, there's no re-estimation, there's no market machination. This is a very simple question that anybody can answer. And obviously it's designed to work with Lean Startup, but it's completely tactic agnostic. If you wanted to use StageGate or some other agile process or whatever you want to come up with, as long as it iterates on a relative frequency and it produces market learning, you can use it to value your current activities. So let's look at this in practice. Let's say you get your $1 million, you start to explore the market, you've got your plan that says it's going to be worth what it is, and you start to do your market testing. You start to test your leap of faith assumptions using lean startup method. And after the first quarter, you sit down with your finance board and you say, we got really, really good results. We've got this validated learning, signed projects. Finance agrees and says, great, let's plus this option. The value immediately jumps to 8.9. You go to the next quarter, things are still really good, you're very excited, the value now jumps automatically. Third quarter, it didn't go as well as you had hoped or had planned, but we didn't crater either, so we're gonna call it station keeping. Finally get to the last quarter, sales were awesome, things are gangbusters, they couldn't possibly be better, we're going to uptick. Now you can see that the value of the option of 46 million is a positive option. We should make this investment. Sometimes things don't always go great. So let's say you go to the first quarter, positive results, but then things start to go sideways, and then things are going bad. Nothing that I said would happen has happened, things are all bad. Now the value of your option is worth 0. Notice, you don't have to spend $10 million to find out it's nothing. That's the purpose of the option. So we're gonna pass. We're not gonna do this. We're not gonna spend $10 million to lose. Now, something else that's very interesting is that sometimes things go really bad. And so you don't see any good news whatsoever. And so for 6 straight months, you go down in the toilet. At this point, you can see and recognize that there's no possible way you can start to generate positive value no matter what you do. So this is clearly a case where we need to pivot. Now notice, there's no drama about this. There's no angst or figuring out, should I, shouldn't I? It's a very simple financial calculation. And we should obviously apply the scarce resources of the firm to something that's going to be more effective. And we now have the time to do it because we figured it out halfway through. And when you schedule these in advance, these decisions become much, much simpler. So as we can see, the process of going through our assumption testing has generated a new price for the option at every step of the process. We are measuring learning. What we need to do as product people, in dollars, what finance needs to do their job. Because the last time I looked, learning is what we need to be doing, but it does not appear on any balance sheet. But wait, there's more. One of the other things that is omitted by the financial option pricing model is a measure of risk. Now, this is risk not in a product contingency planning sense, but in a volatility of your investment, a very financial-oriented risk, and it's called the sigma. Not to be confused with Six Sigma. This is risk sigma, okay? And the riskiest thing you could possibly do when iterating is to have one and done. And this is your traditional linear product model. We'll try it once and see what happens. Nothing can be riskier. If we take the earlier inputs and apply it to this and say we're only going to iterate once, your sigma is 1.6. But the more frequently you iterate, the more opportunities you have to test the market and your relative risk goes down. If you are able to do it once a month, releasing and testing products, your sigma can go all the way down to 0.4, which is actually quite low. Now, the important thing to understand about sigma is that it's a normalized metric. It's comparable between all of your projects and apples to apples. It takes into account the investment amount, the potential return, the duration. All of these things are taken into consideration when generating that number. And with a comparable between projects, you can now enable corporate governance. You can look at 2 projects and say, which one should I pursue? Well, they have the same valuation. I'll go with the one that represents the lower risk, the lower sigma. Or you could say this firm is not going to entertain any projects that have a sigma of higher than 1.0. We simply will not take that level of risk. All of this corporate governance becomes possible when you have that normalized metric. But there is still more. You also get KPIs, key performance indicators, that are needed by finance in order to do your job. And the KPIs focus in not on your ability to tell the future and punish you if you weren't able to predict that revenue a year ago. It actually is that you want the truth. fast. So the first KPI we just discussed, that's sigma. The faster you go, the lower the risk. And if you miss an iteration, the risk goes way up. So that's a way for you in finance to keep the project on track. And the second thing is the truth. You want to know the answer as whether or not you made the right decision. Now, this is a lagging indicator, but because at the end of the day you have to choose whether to invest or to pass, you can produce this very reasonable matrix. And this is the result of the exercise. So you either decided to invest or pass, that's on the left side, and then you had an actual result. That was the right decision or the wrong decision, based upon what you observed from that decision. If you decided to invest and that was a good decision, true positive, we made money, success, hooray. But also notice that you're rewarded if you decided to pass and investing was the wrong decision. This way, you avoided a bad opportunity and you have an opportunity of benefit from doing something different. Those are the things that you want, true positive and true negative. What you want to avoid is the false positive, where you decided to invest and you threw it all away because that was the wrong decision. Or you decided to pass and somebody else did it and made a ton of money. You missed that opportunity. So in both cases, true is what you want and false is what you want to avoid. In other words, accurate bad news is far superior to inaccurate good news. Inaccurate good news is what causes you to make incredibly poor decisions that you think at the time are exactly right, but don't find out until later. We need the truth, we need reality so that we can adjust and make the decisions to make the most of our opportunities. Now, there are some other KPIs that fall from this. Sensitivity and specificity, your true false, your true positive, your true negatives, measures of accuracy, fallout, miss rate, PPV, FOR. Those of you who are familiar with clinical trials, this will be instantly recognizable to you. This is setting up a binary classification matrix that represents clinical trials for your business model. And let's think about this for a second. When you're actually doing clinical trials for like a new cancer drug, do you sit and build a spreadsheet and develop it all in your lab and then just say, I'm done, let's go release it and send it to millions of patients and see what happens? No, of course not. You test it first. So why do we launch these billion-dollar projects without engaging in the simplest of clinical testing? That's what Lean Startup is, clinical testing for your business model. Now, a word of warning. You'll notice that neither of these KPIs is what I started off the talk with, valuation. Valuation is not your KPI. If you insist on only seeing an increase in valuation at every step, you are going to merely reproduce the same problem of the traditional analysis, but with vastly complicated math. It's a very bad idea. Don't do that. Instead, you need to think about this differently. We want our profits to go on forever. Absolutely, we do. We just know that sometimes that won't be the case for our established businesses. So we need to have something to replace it when it goes away. That's what our innovation projects are. And the way you need to think about their value is the insurance policy that they represent to the firm. Nobody gets to the end of the year, looks at their premiums from their life insurance policy and says, you know what? That life insurance policy was a complete waste. It didn't pay off one dime. Nobody buys an insurance policy hoping to die, but it has value because it helps protect against this relatively rare, but when it happens, super disruptive impact to your business. So, innovation options are profit insurance. And when you think about the money that you spend on them, that is the ROI calculation that you need to present to your firm. Because if they just view it as money that you're spending, you're a cost center. And does anybody know what we do with costs in large organizations? Yes. And we don't want that to become you. So, value, risk, KPIs, we can measure all of this. That's accounting. That's innovation accounting. So in sum, product is happy. There's no traps. It's focused on learning what you need to be doing in your organization. It rewards speed, and most importantly, it rewards the truth. And finance is happy. It reports in dollars and sigma and risk, what they need to do their job. And it allows them to choose between products and allocate resources to the firm, and if necessary, rebalance the firm so that it gets put on the efficient frontier of innovation. And lastly, it has meaningful KPIs, ones that we can actually use that do not require you to become a better fortune teller, but to become much better at identifying the systematic error that's involved in your clinical trials. So, traditional approach, that is about delivering on your fabrications. Innovation accounting, it's about determining reality. If you want to have an effective innovation accounting in your system, always make sure that you are focused on the one thing that you need to be successful. Good, bad, or indifferent, it's the truth. So make sure you concentrate on finding the truth. For those of you who are interested, the equations will be made available, and if you are an Excel hound and want to subject yourself to that pain, feel free. If you would prefer to just have software do it for you, I've built that at innovationoptions.com. Please feel free to go ahead and check it out. My Twitter handle is David Binetti. You can search for me. My cell phone is on my website. I look forward to hearing from all of you if you like. Feel free to contact me anytime. Thank you so much. Enjoy the rest of the conference.